And so as we look at kind of what's transpired, obviously there's the virus and, people I think will blame a lot of kind of the economic issue on that, but that's not the full story. So maybe kind of walk us through how have we gotten from that roaring period to now, double digit losses in a matter of months, in really 1 month, in the stock markets, commodities falling, and kind of this deflationary liquidity crisis.
Yeah, look, it is again that giant question for all of us to think about, and it's why Congress is pulling out all the stops and pulling out the giant bazookas with a couple trillion. And I love how we throw the T word around, right? I mean, in the 30s it was millions, and then in the 60s, 50s, 60s it was billions, and then in the 2000s it was hundreds of billions, and now we're talking trillions. And a trillion, just 1 trillion, forget 2 or 6 or whatever the number is, but just 1 trillion is $1 every second for 31,710 years. I mean, that's just a giant number. And so Congress is freaking out. The Fed is freaking out. They put out 4 trillion. Now that's a headline number. They've offered 4 trillion of support, but no one's actually borrowing that money. I think the day they put out the $1 trillion repo line, only 17 billion got pulled by the big hedge funds. Let's be very clear and transparent about this. The Fed action was to backstop these quasi financial institutions that, while the banks don't need a bailout this time because they've been restricted because of Dodd-Frank in how levered they could get, there are no such restrictions on the big hedge funds and the prop trading desks off Wall Street. So they have huge leverage, arguably 10, 15, 20 times, and some of them were gone, right? They were just done. And I still think there's going to be some bodies that float to the surface here over the next couple of weeks. But all that money isn't. It's
really interesting about about the leverage. I want to go a little bit deeper on that because 2 things here. So one is we've seen a couple of firms who haven't been able to meet margin calls kind of raise their hand and have to alert people to that. But I don't think people really understand this whole repo market and kind of bailing out of the hedge funds. Maybe just explain that a little bit more as to kind of what's happening there, and then how the hell is it hedge funds on the other side of that?
Yeah, look, it's a really interesting phenomenon, right? Which is leverage in and of itself is not a bad thing, right? Many of us use leverage in our lives, although I guess it's getting less common as less people own homes. But anyone who owns a home uses a lot of leverage, right? They put 20% down or less. Some FHA loans are 3% down or 2% down. So you're using a lot of leverage to buy physical assets. And it's not different in the banking and finance world. Like a bank takes a deposit and they hold a portion of it. They lend out 90 some odd percent of it. Fractional reserve banking, somebody else deposits that 90 cents, then they keep another 9 cents. They lend out 81 cents. And so you get this rehypothecation, you get this building up of leverage in the system. And all those loans that went to quasi financial institutions or hedge funds, a lot of them started doing trades around fixed income markets that historically they wouldn't have done because there was plenty to do in equity markets, but equity valuations got really high, and they would normally do things like arbitrage, merger arbitrage, or convertible bond arbitrage. But in a ZIRP world, in a zero interest rate world, arbitrage is really hard. When you think about it, if you're $1 long and $1 short, your dollar sits in cash. In the old days, you made 6-7% just on your cash. Then you made money on your long, you made money on your short, and you were levered. So making double-digit returns as a hedge fund was child's play. Now you had to have some skill, but it really wasn't that hard. In a ZIRP world, you're not making any money on your cash. You actually have to pay to borrow. So you have no short interest rebate where you were making money. You're actually paying to borrow. So you're in the hole. Alpha gets crammed down because there's so many firms competing for the same ideas. Because again, the old days of investing, it was about access to information. right? Not illegal information, but access to information. If you could get information faster, if you could get information that other people didn't have, then you had a huge advantage. Well, suddenly, with the advent of Bloomberg and other resources, information became ubiquitous. And once information is ubiquitous, access isn't really that valuable. Then it became about processing. Did you have computers that allowed you to process information faster or model faster or build, ideas faster? And the problem is then everyone got fast computers. So that went away. So then it became about synthesis. Like who could synthesize and who could take all the disparate information, and information became a commodity. Again, information became ubiquitous. Everyone had the same information. It was in real time. You had actually regulations like Reg FD, as my friend in Boston calls it, regulation feckin' disaster, that disallowed people from doing their job, which would be to build relationships with corporate CEOs and CFOs and be able to ask them really hard questions. And the answer has to be no, I can't tell you that. I got to release the information to everybody. So it all became about synthesis and understanding what's not important and what is important. So all this comes down to the fact that these funds started doing some of the things that the infamous long-term capital management did. Things like basis trading or things like convergence trading. And let's just talk about a convergence trade for a second. So if you take a 30-year bond, we know one thing with certainty. In 365 days, it will be a 29-year bond. And then it will no longer be what's called on the run, meaning the popular treasury for hedging and investment purposes. So with absolute certainty, in 365 days, it's a 29-year bond, no longer a 30-year bond. Now, a 30-year bond trades more expensive than a 29-year bond, even though they're basically the same bond. But you can make 5 basis points. Well, 5 basis points isn't a lot. But since it's a guaranteed event, there's no risk. Well, there's no risk if you can hold the trade for 365 days. But let's say you put on a 5 basis point trade and you put 100 times leverage on it. And let's say there's some dislocation in the market and that 5 basis point spread goes to 10 basis points. You've now lost everything. You get a margin call and you're forced to liquidate, even though you know with absolute certainty if you could just hold the trade. So that was one type of thing that started to blow up. But then there are these other bonds that people were buying in the hedge fund space where there's what's called mark-to-market risk, which is if you think about liquid tradable senior debt, bank loans, senior secured loans, investment grade bonds, they should trade at par, right? You're going to get your money back. They shouldn't trade at a discount. But wait a second. If there's a liquidity crisis, if there's a period where people get afraid, and that's where COVID comes in. COVID becomes a stimulus, a prick to the bubble. It's not the bubble itself, but it's the pin to the bubble. And suddenly people are fighting for liquidity and they get a margin call on their equities. Well, when you get a margin call, you're not able to sell what you want to sell. You sell what you have to sell. And so some of these bonds that were very, very safe suddenly gapped down. So you had, senior secured bonds that suddenly should trade at 99 or 100, suddenly trading at 90. Well, if you own those with cash, no big deal. Oh, but if I own them with 10 times leverage, I just lost all my equity. So these things start unwinding, and you saw, LQD, for example, the ETF for investment grade bonds fell 7% in 3 days. It's never fallen 7% ever. It shouldn't fall 7% because it's investment grade bonds. And those bonds, most of them are going to be money good. Unless, and we'll talk more about this later, unless the response to the virus in shutting down global economic activity leads to actual defaults in those investment grade bonds because they borrowed too much money, they didn't spend enough on R&D, they didn't save for a rainy day, and they don't get enough bailout money. Well, that's a long-winded way of saying funds were doing things that normally appeared to have low risk, but a black swan event, which wasn't necessarily the virus itself. The virus is a bad thing, and we can argue how bad it is. And, if you look at the number of people who've passed away from influenza this year, it's 23,000 in the US, and COVID is, had 820 deaths. Which one is worse? I'd argue 23,000 is worse than 820, but maybe 820 is going to grow. And so we can have that debate all day long. But the key is, it's not the virus, it's the response and the drop in economic activity, the drop of cash flows, and the threat of what seemed like a very, very safe thing suddenly becomes unsafe.